Excellent. Well, thank you all for joining us today. We're so excited to kick off 2026 with our Q1 economic and market update. We have a ton of awesome data in here and facts. And what we want to share with you today is the information that we're looking at as we make decisions in both investment portfolios and allocations, and also that you can use as business owners, as entrepreneurs, as balance sheet stewards of your own wealth to continue to make great decisions, whether it's in your investment portfolios or in your real estate decisions or in your private asset allocations or in your business decisions. And that's what this data that we're going to talk about is going to help drive. So with that, I will pass this off to you, Josh.
Awesome. Can you hear me okay, Morgan?
Sure can. Yeah, perfect.
Awesome. And I'll just mention, when I pull these slides together, I end up cutting out probably 50% of the slides that I pull together initially. So there's a lot of data that I have access to. So if there's something specific that is on your mind that I don't cover here, feel free to reach out. Happy to try to find any information, whether it's real estate or anything else. There's a lot of information out there. So happy to help out. So in summary, we're just gonna start with a quick review of 2025. We'll touch on the economy. We'll then dive into the markets, and then we're gonna end with a summary and then a game plan. So let's start with 2025 in review. So I picked what I felt like were maybe five of the biggest surprises or drivers of 2025. The first one that dominated headlines, especially in the early part of the year: tariffs, the tantrums of the markets in response to the tariffs, and then, for lack of a better word, the chickening out, right? There were tariffs announced, and then it was pulled back, and then there were more tariffs announced, and then pulled back, and a little bit of this gamesmanship around using tariffs as a negotiating tool with other countries. And the markets obviously responded very poorly at first, and then we saw a relatively quick rebound in the markets, and then the markets ended up performing relatively well last year. We continue to see these rising geopolitical turmoil across the world. So we bombed Iran. That was not on my bingo card for last year. We're seeing a little bit of a fray that's happening and developing with NATO and the EU. You're seeing countries, whether it's Venezuela or Turkey or some of these other countries that are having serious economic problems and political problems, and not even to mention, Russia and Iran. And if anybody read the articles today on the Wall Street Journal about the EU preparing for a potential war with Russia and how they're not prepared right now, and so there's all these things in the news, and so you can obviously see that rising geopolitical turmoil was an issue last year and continues to be an issue this year, and I think it will continue to be an issue over the near term. Precious metals, any gold bugs out there have had a really good run last year and had a pretty good run the early part of this year. And then we saw a big correction last Friday, both in gold and then a much bigger correction in silver. I think that there are some real fundamentals that are driving the rally in some of these precious metals, but I also think there's an element of speculation. There's an element of leverage in the financial system that is also driving some of the performance there. And I think you saw a lot of that get bled out of the markets last Friday. AI is continuing to dominate the news. It continues to dominate the investment world. I mean, anything related to private investments is being dominated by the AI story right now. So I guess the question is it a bubble? Is it a life-changing technology? I think the reality is just somewhere in between. I think there's pockets of bubble-like activity, but at the end of the day, I do think AI is going to be life-changing. I think that there's products that we haven't even imagined yet that are going to be developed, powered, and using AI to run them. And I'm excited for the future. I think this is going to be game-changing, like many of the other game-changing technological advancement that we've lived through in our lives. We are seeing some softening employment data, although it's somewhat improved over the last, for sure over the last month. And then you also have this immigration. I don't want to get political here, but it's very clear that we used to see relatively high immigration numbers. So we're talking up to the tune of, a couple million people coming to the United States. That has declined precipitously with the closing of the borders. And so this dynamic of a little bit of a softening of the employment picture combined with less people coming in is resulting in an interesting output as far as looking at these economic indicators. And so we'll touch on that just a little bit. Real quick, so just talking about performance, I mean, we saw international equities finally have their day in the sun, and then we saw U.S. large cap almost 18%. You saw commodities really driven by those precious metals having good performance this last year, but we also finally saw bonds have a relatively decent year, right? 7.3%. This is after a number of weaker performance in bonds. And then we saw real estate really kind of struggle last year. And so we're going to touch on real estate here shortly in this presentation, but I just want to point that out as well. What was driving the strong performance in US equities? And I'm just going to summarize this quickly because I want to touch on this a little bit more in depth when we talk about markets. But if you look at earnings growth, 11% earnings growth in 2025. So companies are growing, they're growing their earnings. How are they growing their earnings? You're seeing a combination, if you look up here, you're seeing a combination of both strong margin being a driver of earnings growth, and then you're also seeing relatively strong revenue growth as another driver. So it's really that combination of efficiencies being gained by these companies, cutting costs, all those things, better margin on top of this relatively strong revenue growth that is really driving this earnings growth. So let's shift now to the economy. And I think that I'll just start out by saying I think we ended the year on very strong footing, and therefore we've entered this year on a very firm foundation for the economy. Here's some data that's looking at the probability of U.S. recession by the end of 2026. And you can see a very steep decline here over the last 3 months as far as the probability of an expectation of recession by the end of 2026. So what this data is just pointing to is that the market participants are not expecting a recession like they were towards the latter half of last year. So I think that that's good. If we look at some of the data around the U.S. economy, I think this will be a little bit enlightening. Morgan and I were talking about this today. You go to the doctor, you get your blood pressure checked, you get your healthy fat levels checked, the bad fat levels checked, you get your heartbeat checked, all these things. Well, economists do the same thing, but they do it for the economy. So what this is looking at is we're looking at GDP growth. So gross domestic production. We're looking at how much goods and services are being produced in the United States. And that's what this measurement is. For an economy that's our size, the largest economy in the world, you're looking for a 2% number, if not better. If you're growing at 2%, that's a very strong number. And obviously, we had some weakness driven by the tariffs in the first quarter, but then we saw a very strong rebound, 3.8%. We saw 4.3% in the third quarter. So these are just terrific numbers in the second and third quarter. And if we look at expectations, this is data out of the Atlanta Fed, where they are forecasting what they think based as they get more and more data, they're forecasting what they think GDP growth is going to end up being at the end of the fourth quarter of last year. You have blue chip economists down here. You have this real-time data expectation. So they're right now forecasting just a little bit more than 4%. It may come in a little bit lower than that. But as this has gotten closer to the end of the first month of last year, it ends up being pretty accurate. So what does it tell us? That we're seeing very strong GDP growth towards the end of last year. And I think that that's bleeding into this year as far as expectations on how the economy is going to perform in 2026. In fact, on that note, this is consensus GDP forecasts for 2026. And you can see that once we hit the tariff tantrum, expectations were that GDP growth would slow. And now as the year continued, we're back up to 2%, north of 2% as far as what expectations or consensus expectation forecasts for 2026. So GDP, the economy is relatively healthy. Another data point as far as measuring the health of the economy is the unemployment rate. So as we can see here, unemployment was it was near 50-year lows post-COVID. We saw unemployment rise, but a 4.4% number in unemployment is relatively healthy, if not maybe even a little what they would call in the industry a little tight. It's a 4.5 to 5 is very normal and very healthy. And so this, even though this looks like unemployment has weakened, which it has, this data point right here is still a relatively healthy number. And as you can see, it's actually trended down slightly since the last month. Another real-time data point or leading economic indicator that we like to look at is initial jobless claims and continuing claims. And so both of these we've seen some improvement over the last couple months. So this comes out every single Thursday. A 200,000 to 250,000 data point is very normal. So you can see that we've recently kind of been on the lower end of that range. And then if you look over here at continued claims, so these are people that have made an initial claim and then are continuing to claim unemployment. You can see that, yes, we saw some softening in the employment picture as we saw in the unemployment data. But then you can see here that we've seen some stabilization, and now we're actually starting to see this decline slightly. A 1.7 million to 1.8 million number is not terrible. That's very consistent with what we were seeing pre-COVID. Where we have seen some weakness in the employment data, this is looking at cumulative change in employment since January 2024. So what we're really focused on is Liberation Day, the beginning of the tariff tantrum, and how that potentially impacted employment. And the part that I want to show you where there's the biggest impact has largely been in smaller firms. Firms with 1 to 49 people have actually been hurt the worst, and it's probably a combination of tariffs and maybe even a little bit of AI. But I would say probably tariffs is the bigger driver there. Now, shifting away from GDP growth and shifting away from unemployment, we're going to focus a little bit now on the consumer and what people are doing. I like this data because this shows us year over year sales for retail, for shoppers. So you can see these numbers here are very healthy. They're very similar to the numbers that we were seeing pre-COVID. So a 5% plus year over year growth in retail sales is a very healthy number. So what does this data tell me? It tells me that people are out there and they're shopping, they're spending money. We're not seeing symptoms of a recession, at least you looking at this data point. This data point is a little stale. Apologies, I couldn't find one that's more current, but I think there's still an important point to make with this. This is the daily data for US air travel. So people going through TSA check-ins. And you can see that this 2025 number is right on top of 2024, right? Right on top of it. Now, I looked at the underlying data this morning, and we actually had 2 record days this year. End of June, we saw record travel in the United States. And then end of November, we saw record travel in the United States. So those 2 data points point to me or tell me that this line has just continued and that you're likely probably going to have you likely had record travel in 2025. If not record, it's going to be right on top of 2024, which was a record year. So once again, another data point that shows me that people are out and they're traveling, they're spending money, the economy is relatively healthy. Banks are lending again. We're seeing that in both the United States and in Europe. So you can see here, this green line is the year over year growth. And so what does this tell us? It just tells us that banks are growing their loan books. They're out there lending to individuals. They're lending to businesses. Lending to individuals means that individuals are out there. They're buying homes, they're buying cars, they're spending money. Lending to businesses means those businesses are likely spending money on their business. They're buying other businesses, they're buying goods, they're buying manufacturing equipment, whatever it may be. And so that spending of money for a business on manufacturing equipment, for example, is called CapEx or capital expenditures. So this is a way to measure how bullish businesses are, because if a business is not expecting to spend money on CapEx, then they're not expecting to grow. So that's really what this data is all about right here, is this CapEx kind of boom that we're seeing. So we had a big CapEx increase in expectations once the Trump administration, once it was announced that President Trump had won the election. We hit the tariff tantrum. And then now we've come out of all the uncertainty of the tariff tantrum, and we're seeing these numbers come up again. So all this is telling us is that businesses are basically planning on spending money in order to improve their businesses and to grow. Speaking of tariffs and the tariff tantrum, This is where tariffs, when they were initially announced, came in. We're clearly at about almost half that level, so not nearly what it was going to be or what was initially announced. What effect has that had? This is some interesting data that's looking at Chinese exports to the US. So I want you to focus on this left-hand side of the chart, and we're going to focus on this green line. You can see that this, bounces around, but it's somewhere between this, 16 and 20%. But now once you get to this time frame, you can see this massive decoupling because of tariffs between the United States and China. And that is an impact of tariffs. Now, this data is probably somewhat distorted, right? We've kind of gone from this almost 20% back here to down to 16%. Now we're down to 10%. Now, I think that what we're seeing is a little bit of a distortion of data where there's probably goods and services produced in China that are making their way to the United States through an intermediary. So it's probably not quite as stark as this, but it is clear that there has been a decoupling between the United States and China, and you see that in the data there. Now, what is the impact of these tariffs? Now, we have not seen the inflation expectations that I think a lot of economists were expecting, including, and I'm not an economist, but I was expecting a little bit more inflation due to the tariffs. We're starting to see a little bit of inflation bleed into these numbers. So this is inflation data, and it's broken down. These different colors are the different parts that are measured for inflation. So where are we seeing disinflation? I mean, you're not seeing red anymore. So we're not seeing big increases in auto insurance. You're seeing shelter continuing to decline. Shelter is an interesting inflation number because it has a lagged component to it. So it tends to rise much more slowly than the broader real estate market, and it tends to decline much more slowly than the broader real estate market. And declining can be year over year change, right? Like if your how much you're paying in rent is the same year over year, then that would result in a 0% inflation. So you don't actually need housing prices to go down in value to see a disinflation effect from shelter. Where we're seeing a little bit of inflation pressure, and this goes back to my comments around tariffs, is this core goods. So I do think that we're starting to see a little bit of inflation pressure bleed into these numbers because of the tariffs, but it's largely being offset by some of this data, right? The auto, the shelter. So the net effect has not been as strong as I would have expected. And so this is good news for the Fed. And if you remember, the Federal Reserve has two responsibilities. The Federal Reserve is there to ensure stable prices, which they have targeted to be about 2%. They're comfortable with prices increasing by about 2% a year. And then the other part of this is they're trying to manage employment. So they want full employment. They want an unemployment number somewhere around 5%. And so the Federal Reserve uses interest rates to try to influence the markets in order to either spur economic growth or to pull back on economic growth, to slow down economic growth. So you can see that happening here when the Fed started increasing interest rates. What were they trying to do? They were trying to rein in the economy. They wanted to slow the economy down so that way they could get inflation under control. As inflation started getting under control, they started decreasing interest rates because they started to be a little bit more worried about the employment picture, whereas here they were almost fully worried about inflation. And now we're looking at expectations for inflation or for interest rates that are controlled by the Fed going forward. So if there's two data points I want to point out here. One is just what the Fed expects at the end of each year. That's that blue line. So the Fed expects basically one rate cut, right? About 0.25% lower than where we're at right now. Then they expect another rate cut at the end of 2027. Now, the market is the green line here. The market's actually expecting closer to 2 to 3 rate cuts. So there's a bit of a disconnect between where the market is pricing in, where the Fed is going to cut rates, and where the Fed is currently expecting. What's interesting is as we go forward, this is a new anomaly, by the way, in the data. Now the market's starting to price in that we start seeing interest rates start to rise again in 2027, 2028. Very fascinating, a very interesting like nuance to this data. And what does that tell me? It tells me that the markets are starting to price in potentially some inflationary pressures, potentially stronger growth pressures Yeah, and growth is not necessarily, and growth can kind of be viewed as a bad thing in the sense that if you're growing too fast and you're causing too much inflation, then that could cause the Fed to increase interest rates. So interesting data point here that we're seeing related to kind of expectations on where interest rates are going. Let's shift over to the housing market. So here's some interesting data. This is from the Wall Street Journal, which sourced it from Redfin. And all of us live through this. All of us have neighbors who sold their homes or were trying to, or people that were trying to buy homes and they were having to pay so much more than the asking price in that post-COVID, world of low interest rates and everybody's buying a second home. And so we're finally seeing in 2025 some normalization of the percentage of homes that were bought above the listing price has finally kind of gotten back to a more normal pre-COVID level. So I think that's relatively healthy for the real estate market. Despite that fact, though, this measures housing affordability. So the higher this number is, the more affordable homes are. The lower this number is, the less affordable homes are. We're clearly in a relatively unaffordable time to buy a home. Why is that? This, and we all know this, mortgage rates remain stubbornly high. A 30-year mortgage on average costs $2,700 a month. Now it's come down, so we're starting to see a little less pressure, but it's still well below what we saw pre-COVID, right? Where the average 30-year mortgage was closer to 1,500. So that is driving the unaffordability conversation. We're going to now talk about the markets. Investor sentiment. This is a survey that's sent out to investors, that's measured every single week. You can see the historical averages. So historically, about 37.5% of people are bullish, 31.5% of people are neutral, 31% of these investors are bearish. We clearly have come from a very bullish time at the middle of this last month to now being not nearly as bullish. These participants in the survey are still a little bit more bullish than the historical average, but not nearly as bullish as they were a couple of weeks ago. And we're seeing that play out in the markets. We've seen a couple of days of weakness in a row in the equity market. So we're seeing a little bit of bearishness starting to bleed in. So what's going on looking forward? If we ended the year, the S&P ended the year at about 68.50. The forward PE, that is the price to earnings ratio. It's just a very loose metric that's trying to measure how expensive are stocks, relative to their earnings. And so for this one, it's looking forward and saying it's about 22 times. This is relatively high compared to kind of previous data points, but I don't think that this is the end all be all measurement. And if you're looking at this and saying, oh, I don't want to buy stocks because they're just too expensive, the reality is that equities, the end of last year, so let's go back to the end of 2024, had a very similar number as this. I think it was about 21. And we saw 17% performance in equities last year. So just because you're starting the year at a relatively high PE ratio doesn't mean that you can't have very strong performance in equities. And I think last year is a very great example of that. So it's really dependent. Performance is really dependent on earnings. And if you look, we already talked about 2025. Let's shift to 2026. Markets are expecting 15% in earnings growth. So it makes sense why markets are relatively expensive relative to historical levels, because the markets are pricing in relatively strong earnings growth. And we just talked about the economy. We talked about unemployment, all these different factors. It makes sense that if the economy is healthy and people are out there spending money, then you would expect to see relatively strong earnings growth at these companies. And I already mentioned this, but this margin expansion is pretty fantastic. And so I think that we could potentially see this margin expansion, these profit margins increasing even from where the high levels that they're currently at. Now, there is this element, and there's people that talk about this. You look at the 10 largest companies in the S&P 500. The S&P 500 is simply just an amalgamation of the 500 largest companies in the United States, measured by what's called market cap. So how much the companies are worth. And the top 10 companies, as far as how expensive they are, is about 28.1 times, which is higher than the 22, which is the average for the S&P 500. And then the remaining companies are about 19.2. So if you look at this data, you would say, okay, well, wow, like those top 10 companies are much more expensive than the remaining companies. But it makes sense why they're so expensive. So now let's shift, instead of talking about top 10, let's just talk about the Magnificent Seven, which are part of that top 10. The year over year earnings growth for the Magnificent Seven has just been tremendous. And so, you had really strong earnings coming out of COVID. You had a weaker year in 2022, but then look at 2023 and look at 2024 relative to the rest of the S&P 500. Look at 2025, double the earnings growth. Look at expectations for 2026, double the earnings growth of the rest of the S&P 500. So yes, these are expensive, but they're expensive for a reason. I mean, these companies are just tremendous companies that are generating significant cash flow, that are driving large parts of our economy. And so it makes sense why these companies are a little bit more expensive. And it makes sense why the overall market is a little expensive relative to the long-term averages. I mean, I hate saying it, but I almost think that we're in a bit of a different regime now relative than we were, 20 plus years ago. Here's just a little bit of kind of seasonality data, I guess you could call it. So if you go back historically and you see returns in January between 0 and 2%, which we clearly were in January, for all of those years, if you look at the next 11 months, you only have 1 year that was negative. All the other years have been positive. So just a potential indicator that we could look at that says, hey, well, historically speaking, when January's been between 0 and 2%, historically speaking, markets have tended to be positive. I've got to mention Bitcoin. Bitcoin's clearly has been in a correction. And the thing that I would mention, and it's fascinating because I'm looking at all these articles about Bitcoin, and I mean, it seems like everybody has just thinks that Bitcoin's done. And I'm not going to say I'm pro Bitcoin or against Bitcoin, but it's interesting to watch as the markets just completely flip from bullish to bearish, and how the articles that you're reading when Bitcoin's really rallying are all about how Bitcoin's amazing and Bitcoin's going to be $1 million a coin. And then you look at all the articles that are coming out right now, and all the articles are saying that Bitcoin's going to be zero. The reality is the truth is somewhere in between there. So I think you have to like frame this in your mind and have an open mind and realize that like Bitcoin's probably not going to go to zero. It's probably not going to go to a million. But historically speaking, Bitcoin has had some very large periods of volatility, but it has tended to bounce back up. So I'm not saying that you should buy Bitcoin right now, but I'm just saying that the reality is that we're clearly seeing what has happened before in the past with Bitcoin, in the sense that it has sold off pretty significantly relative to its highs, and we're seeing that play out again. Gold and silver, I mentioned them a little bit earlier. We saw strong performance in both of these precious metals in 2025, and we've seen really, decent performance through the beginning of this year. We saw this correction last Friday. And so I think if, once again, like if you're bullish on precious metals, this correction might be an opportunity for you to step in. Just want to point that out. We talked about this in the past. I love this chart because I think it tells a very interesting story. It tells a story of something that all of us have lived through multiple times, which is these bull cycles in commercial real estate that tend to last about a decade, followed by these periods of recession and a pullback in real estate, and then followed by bull cycles. And what's fascinating is if you look at the compounded annual growth rate, the performance of these investments in real estate, and this is core commercial real estate. Think, obviously there's some office in here, but there's also industrial, multifamily. Those are all considered core commercial real estate. And then, of course, we come out of the great financial crisis. We have another cycle. We come out of COVID, interest rates spike, and then suddenly we go through another cycle. So I can't help but think that although history doesn't always repeat itself, but it does tend to rhyme. If I was and I am an allocator of assets, but if I was looking at this, I'd probably say to myself, well, I think there's a pretty high likelihood that I think commercial real estate could be a good investment over the next 10 years. So we're starting to weave a little bit of that into our portfolios that we manage. Jumping into summaries and game plan. So this is just purely educational. I just want to remind people, bull markets tend to run, and they tend to run for about 5.3 years on average, and they tend to perform very well. Now, bear markets tend to last for a very short period of time, about 1 year. Although I would say, the most recent one last year was only about zero point 0.1, right? It was a month or two, same thing back in COVID. But for the most part, bear markets are very quick and then they get over with. And then you have typically a nice bull run that on average has been about 5 years. The last two have been closer to 2 years. But the reality is bull markets last a lot longer than bear markets. We want to make sure that everybody knows to expect volatility this year. This is just the way in the investment world works. Is it's volatile. And if you look at some of this data, I think it's eye-opening. You should expect that every 18 months to have about a 10% decline, intra-year decline in the S&P 500. So if we see a 10% decline in this year, people should not be freaking out. This is what we would expect. Every 2.5 years, we'd expect a 15% decline. Every 4 years, we'd expect a bear market of 20%. So just remember that if we have some volatility, this is to be expected. And this is what Morgan and I always talk about is the price of admission. If you look at this data, here's the annual performance across all these years. Most of these, as you can tell, are positive. Here's the intra-year pullbacks in each of these years. So even in some of these good years, right, 24, 23%, you still saw pullbacks of 10 and 8%. These red numbers, this is the price of admission to this. And I love this chart. What this chart is showing you is if you'd invested $1 back in September of 1989 till December 2025, that $1 would turn into about $41. Now, during all of this time, you had all of these reasons not to invest. And you also had to live through all of this volatility, right? But at the end of the day, the worst decision you can make is to not invest. As long as you have a long enough time horizon, the worst decision you can make is not to invest. So just want to share that with everybody. In summary, what do we like? What do we don't like? We tariffs have not translated into significant inflation. I didn't even talk about this. The one big beautiful bill, most of the stimulative effects of the one big beautiful bill is going to hit in April around tax season when you're seeing a lot of people get much larger tax refunds than they have had in the past. That is going to be more likely than not stimulative to the economy. Consumers, as we saw, they're still out there. They're spending money. It's largely driven by the more higher income earners, which is just the nature of how our economy has evolved over the last decade. But they're out there and they're spending money. Earnings growth expectations are high for 2026. Government spending is not slowing down. For the Federal Reserve, likely to cut interest rates one to three times this year, which, as I was talking about before, why is that good? Well, if interest rates are coming down, then it means that people are more likely to not let their money sit in the bank and earn 5%. So right now, if you put your money in a money market account, you might get 3.5, 3.4%. If we see three more cuts, that means you're going to get closer to 2.75%. So that's significantly less than the 5% that we were getting a couple of years ago. So this is, just one more, point to a data point that's supporting that as interest rates come down, people are going to be more likely to put their money somewhere else. Where are they going to put their money? They're going to probably invest it in the stock market. They're going to invest it in longer dated bonds. They're going to allocate it a little bit differently because you're not able to get a 5% return like you used to for just sitting in cash. We already talked about this commercial real estate. We do think commercial real estate's in the early innings. We're excited where this could potentially go. What do we not like? We don't like the high starting valuations for stocks, but at the same time, it's understandable. And last year we started at a high valuation and we saw tremendous growth in equity markets. So I would not be making a decision based off of this, just because I think that this is a poor indicator of what could potentially happen this next year. Housing starts are lower, housing starts and houses bleed into a lot of different parts of the economy. So that lower housing starts is going to bleed into the economy. Now, what's bad for one thing is actually good for other things. If we have lower commercial real estate starts and housing starts, it means that hopefully some of these things become a little bit more affordable, maybe a little bit more rare, and that could end up being a tailwind It may be more affordable in the short term, but it ends up being a tailwind for prices over the long run. Potential legality around the tariffs. I mean, we're still waiting for the Supreme Court to make a ruling on whether the tariffs are even legal. And then if they're not legal, what are we going to do with the hundreds of billions of dollars that we've collected from tariffs? I don't know. So there's still some uncertainties around this. U.S. political risks and uncertainties remain high. Geopolitical risks and uncertainties remain high. And then I already mentioned this: government spending is not slowing down, and that's a positive. Government spending is not slowing down. That's also a negative. There is this existential risk that is out there that if we spend too much money, we borrow too much money, we could potentially get on a path that is unsustainable. You liken this to an individual. If you go out and you take all your credit cards, and you max out all your credit cards, and you take out a massive mortgage on a house that you just can't afford, at some point, you're going to have problems. And so we're not there yet. There's still a very clear path for us to get off of this current path, but there is that existential risk. Let's discuss game plan. It's never too late to rebalance. If you think you're taking too much risk in your portfolio, it's never too late to rebalance, de-risk a little bit. Dollar cost averaging excess cash into weak markets is what we should be doing this year. So if we see a 5% pullback, a 10% pullback, those are opportunities to step into the markets. The markets are the one place where when things go on sale, nobody wants to buy. And so you have to think the exact opposite of how you feel. When you see your accounts going down in value, you should be adding. When you see your accounts going up in value, that's not when you should necessarily be adding. If you have a strong opinion on cryptocurrencies, on gold, silver, commodities, now could be a good time to enter in those markets. I'm not trying to time it. I'm not trying to say that we're at the bottom, but I'm just saying that if you have some interest, now's a better time than some of the other times that we've seen over the last 18 months. Diversification is the only free lunch. So we especially like private credit. We like real estate for their diversification standpoints. So we do, and there's other assets too that we haven't even talked about. And so there's some great diversifying assets that still have relatively attractive returns. So just remember that, stay disciplined, stay data driven. Don't believe everything you read, especially AI generated content. And I'll end it on that. See if there's anybody that has any questions.
Josh, that was fantastic. As you know, my favorite, I love the consumer sentiment chart. It's my favorite to look at every single week.
Yeah.
I have just
And
gone
consumer
ahead
sen-
and
and I apologize.
yeah,
Yeah,
go ahead.
consumer sentiment still very weak, and that's largely just driven by the high prices and the inflation that we've seen over the last 5 years.
Hey, Josh, this is Tom Fowler. Can you hear me?
Tom, I can hear you.
Hey, the question I had is probably a simple question, but you talk about the margins improving and it's due to efficiency. Is there anything saying that it's also price because of taking price because of tariffs? I know you said you don't see a lot of it, but is some of that margin increase due to price?
I would think, and this is very anecdotal, but anecdotally, what I had heard, and you might have some insights just because of your connections in in the pharma industry, but I had heard anecdotally that initially companies were eating the tariff costs first, and then they started passing, and they didn't really start passing along some of those tariff costs until the latter half of last year, and even more towards like the latter quarter of last year. So there is probably an element there that is, a little bit of that. And I guess that would somewhat bleed into, I guess, more of that revenue number, which obviously impacts margins.
Sure, that's why I was asking. The
Yeah,
same thing with, and not trying to bring politics into this, but
yeah,
the concern about unaffordability that is constantly being risen, and due to the fact that some of the prices that were increased over the last few years have not come down. And, part of me is just saying, well, some of that may be tariff-driven price increases. That was just
yeah.
what I think could be going on.
Yeah, no, I think you're right. I mean, it's I talked to economists, and the impact of the tariffs on inflation has not been as nearly as high as they were expecting. But I think part of that was because a lot of companies absorbed the cost at first. And I think we'll see a little bit more of that bleed through into the data. But the timing of it makes the inflation numbers not look as bad because you also have some of these disinflationary impacts that we'll see this year.
And one other question. All of the investment that's taking place in the United States that we hear about to kind of reduce tariff levels, right? What is your view as to when you see some of that truly impacting labor markets, productivity in the United States?
Yeah, well, like when do I think that we'll see a lot of that coming into play?
Yes.
Yeah, I mean, I think on the margin, you are seeing it come into play. There's a little, I don't have exact data on it though, but Tom, I'm happy to look into it and get a little bit more specific information on that for you. But I mean, and this is a little bit more anecdotal, but I mean, we're clearly seeing some of that take place. And I'll give you just one anecdotal story. There's a real estate group that I know pretty well, and they started buying some multifamily homes in a town in a little city in Texas, and then guess what? That city, it was announced that they were going to put in a bunch of AI data centers, and so because it was just like kind of an ideal location, and then suddenly you had like that, they're like it's 100% occupancy there in that city now. There is no, you cannot find a place to live in that city. And that when they come like this, when their group comes, they can't even find a hotel. So they end up staying at the house of the manager of some of the properties there because they can't even find a hotel. So
Wow.
I think you're seeing the impact, but I think it's much more regional. And then that obviously regional impact then bleeds into like the broader economy.
Thanks, Josh.
Yeah.
So, Josh, this is Mark Trenchard. um, the sentiment stuff is interesting and the overall aggregate in the economy in terms of sentiment. I might have missed this, but do you have a slide on consumer sentiment? Because
You know,
my
I'm
$30
embarrassed.
pizza last night is giving me some grief.
Say that again. You're what last
My
night?
$30 pizza from
Oh,
Menlo
don't
Park.
even get me started. I remember that not this is very anecdotal, but back when I was at Goldman, this is 2011, we would get a $25 stipend if you worked more than 12 hours, which I did every day. Yeah, you'd get a $25 stipend, and I could buy two meals. Now you can't even buy one meal. I feel like downtown Salt Lake for $25. Um,
Yeah.
Anyway, yeah, I don't have the chart here. I'm happy to email it over to you. I that was one of the charts that I ended up cutting in my cutting process, but just because it had consumer sentiment hasn't really changed much
Yeah.
quarter over quarter. It's still in like the 50s, which is a very low reading. There's the problem with that reading though is it's distorted by the inflation numbers. So there's an element to this that it's like, yes, consumer sentiment readings are low, but it's distorted by the fact that inflation has been as high as it's been. Does that make sense?
Yeah, it does. And what do you make of the Apple announcement a few days ago, where they're just they're farming cash over there? What
Oh, it's tremendous. Yeah.
what does that say for, say, dependent technologies and things like that in your mind?
Yeah, I think Apple's done a tremendous job of like creating an ecosystem that's going to win in the sense that they did not jump into the AI capex, capital expenditure, spending money on building out data centers and all of these things. They did not jump on that boat, which I actually think is smart because I think that you don't know who's going to be the winner in that game, but you know who is going to be a winner? Somebody who has basically owns toll roads that are digital toll roads, which is essentially what the Apple ecosystem is, oh, if you want to come and play within our ecosystem, then you have to pay those toll roads, and we're going to collect a 30% margin, and we're going to do nothing to collect that 30% margin. I mean, it's just incredible the ecosystem that they built. So I think, yeah, I mean, yeah, I think Apple's I know there's worries, right? And there's good reasons to be worried. There's tons of ties to China. If that relationship suddenly frayed significantly, like Apple's obviously trying to diversify their products away from the building of the products, that all of that manufacturing outside of China, but they have to do it in a thoughtful way. They can't just pull the plug on China. That would hurt them so much. And so, I think they've done a very good job.
Yeah, thanks.
Susan, you asked about international markets. I think that I, I hate having a bit of a home bias here, but I just think that if it were me, I would still be a little bit more overweight United States. It obviously didn't pay off last year, but I just think that the United States is still the most robust economy in the world. It's the place where I think that it's the most innovative. And people can kind of argue with me about China, but I just think as innovative as China is, I just think the United States is more innovative. It's more free. It has the rule of law here. And I think a lot of these other international economies, obviously their equities benefited from the weakening dollar. We may continue to see the dollar weaken this year. We've seen a little bit of softness, and then we saw it come back up again. So I, all things being equal, I still like U.S. equities over international markets just because I think the growth here is strong. And I think that the economy, outside the economy, all these other factors point to just a relatively healthy economy. And so I'm still bullish U.S. It doesn't mean that I wouldn't allocate to international markets, but as far as where I would weight things, I would weight it more towards the U.S.
Any thoughts on the M&A market for the rest of this year?
And I'm not an M&A person, but I'll tell you some data points I've seen. I have seen an unusually large amount of companies. So this is not, sorry, this is not M&A. So I'll get back to that. But like a lot of data points that I've seen, and obviously anecdotal, but a lot of companies preparing to IPO. So that tells me that the transaction markets in general seem to be improving. Now it's going to be very specific to the company. But I would think that we're likely going to see an improvement in the M&A markets, largely due to the fact that I think we have more clarity from the administration. I think the administration, it's sector by sector, but for example, like banking has seen a lot of M&A activity because the current administration is much more pro banking and pro less regulation in the banking sector. And so I do think on average, you're going to see an increase in M&A from that perspective. Now, I do think it's going to be a little bit more industry by industry specific, though. Thank you, everybody, for taking the time.
Thank you, Josh. Well done. Love the data here.